Well, the S&P 500 seeing its third straight record-setting session on Tuesday. Mark Tepper with Strategic Wealth Partners, Matt Maley, Miller Tabak. Mark, I mean, I don't even know if the strongest bulls would be surprised this rally. I mean, it is every time you think it fizzles out, it seems to have another leg. Are you surprised at just how resilient this market has been?
No, not at all. I mean, where else are you supposed to invest and make any money? You know, bonds aren't going to provide us with any performance over the course of the next few years as interest rates are rising. So this is really capital chasing yield. So stocks are the place to be. And economically, we happen to be in a sweet spot where the path of least resistance for stocks continues to be up. Consumer confidence is near all-time highs, and while the odds of another Fed rate hike by year end has significantly gone up, really only a policy error where the Fed actually hikes rates even as inflation expectations decline and the yield curve flattens would trigger any sizable pullback in stocks. So, you know, we expect this to continue to go on for at least another year, year and a half.
Well, Mark, I hear you. Let me follow up on that, though. And I'm not saying I disagree or agree, but I will ask this. Is the argument there's no other better alternative, the TINA, there is no alternative argument about stocks, really make them a good investment? I mean, maybe just because bonds stink, maybe cash is king. Who knows?
Yeah. In cash probably isn't, you know, it's not the worst investment because inflation is still relatively low. But, you know, stocks right now, and not even just necessarily U.S. stocks, I know that's what we're talking about right now, are U.S. stocks, but there's also quite a bit of opportunity overseas. So people want to make money. You know, when you look at historical rates of return, people are used to making, you know, high single-digit, maybe even low double-digit returns in the stock market. And unfortunately, when you look at expected returns on a going-forward basis, they're not going to be anywhere near those levels. So it's really forcing people to get more aggressive in their asset allocation and hold more stocks than bonds or cash so that they can meet their expected returns.
Matt Maley, are you surprised at just how strong this market has been? Or like Mark, do you think that it's got some room to run here?
Well, I'm a little bit more cautious in market. Only, you know, it's one of the things we need to know is that, you know, we've had this great run since last year's election, well, up over 21% since last November, but we're only up 3% since mid-June. So the rally's kind of flattened out. As strong as it's been, we've had, you know, obviously almost nothing in terms of pullbacks, but we now are getting to levels of valuation where historically, it's just simply a historical fact, it's hard to see a major rally from these kind of levels of valuation. Yes, we can go higher. But can we go a lot higher? And I think the key is that we've seen this flatten out in the market. Is the key going forward is going to be rotation, being in the right groups, being in the right asset classes. That's what's going to be the thing for outperformance in the market going forward. I mean, we're already starting to see some rotation now with you know, some of the FANG stocks into energy. They might be going into the banks as well. They're starting to move into that area a little bit, but also in other assets where you see the dollar starting to look like it might break out. What will that do to emerging markets? That should be negative for them and maybe negative for commodities. So we actually could see a big pickup in volatility within the markets. It may not knock the market down, but it may create some more activity in the marketplace. So I think investors are going to need to be a little more nimble than they have been for most of this year.
Define nimble. Like, I mean, how much do you have to be moving asset allocation around?
I mean, you know, people don't want to necessarily become day traders, but when you see the dollar with the, you know, it's broken its trend line going back to the beginning of the year. I'm sorry, it's going back about 5 months. And if it can make a higher high, the DXY index above the 94 level, that's going to give it its first higher high of the year, and that's going to, you know, it's going to change its trend. I mean, in other words, its intermediate term trend, it will have changed. That affects multinational stocks. It positively affects the Russell 2000 and the small caps. So I think people, and I'm not saying trade them because they'll change in another couple of weeks. It could be a kind of intermediate term change that gets people to change some of their allocations for the next few months, or 6 to 12 months.
Matt Maley and Mark Tepper, guys, interesting discussion there. And Mark, we're watching that bullish view that you've got here. I know you make a lot of investors happy if that prediction comes true. Mark and Matt, thank you both very much. As always, folks, thank you for watching Trading Nation. I'm Brian Sullivan. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.